Good afternoon, everyone, and welcome to today's Smart Investor session. My name's Mitchell Sneddon, and I'm InvestSMART's Head of Portfolio Services, and I also have a foot in the Analyst camp as well. Before we kick off, I would just like to say a big thank you for everyone who attempted to join us yesterday for this session, and thank you for your patience. We were plagued with technical difficulties, so we did decide to postpone the session. So hopefully today we'll go off without a hitch. So speaking of today, what we're going to be talking about is how I would assess a passive investment. And when I talk about passive investments, I'm looking at managed fund products, exchange traded funds and listed investment companies. A little bit about my background. Before I joined InvestSMART here, I was with the Eureka Report, of course. I was a listed investment company analyst there. And prior to that, I worked with a fund manager, and at that fund manager, we had a listed investment company, we had individually managed accounts, we also had a managed fund product as well. All three products were attempting to run pretty much the same portfolio, so the same investment strategy across them, but they all had little nuances that investors needed to be aware of, and some products, even though it was the same strategy, suited some investors whilst others didn't. And so that's what we're going to be unpacking today. Now, moving on to my very first slide, it is the most important one I'm going to put up all day. It's our disclaimer. So we're going to be talking about financial products. We could be talking about a couple of stocks. We could be talking about some managed funds as well. None of what I'm about to say should be taken as personal advice. It's general advice in its nature. And we will be talking about some stocks, of course, and some positively, some negatively. So do keep this disclaimer in mind. Once again, it's the most important slide I'm going to show all day. So before we do kick into it, I just want to put up this next slide here because as we've been doing these Smart Investor sessions in our Melbourne office, where I'm currently located, and our Sydney office, there's been a lot of questions still about how the three websites do fit together, the Eureka Report, the Intelligent Investor, and of course InvestSMART. So I just wanted to clarify a few things there. No matter where you've come from originally, if you're a Eureka Report member originally or just an Intelligent Investor Report member, you do have access to all three websites. And all you need to do is use your current login details that you've used, say, with Intelligent Investor for years, and you'll be able to access the Eureka Report and the InvestSMART website as well. Now, one thing I really must say, and this is on our next slide here, the central location is InvestSMART. All articles do flow through InvestSMART. And the really handy thing about this is we've now got an InvestSMART app, and if you've got a smartphone, no matter where you are, if you are following our recommendations on stocks, you can stay alert and up to date with the smartphone, with the InvestSMART app. We will send notifications to your phone as soon as we change any recommendation. So no matter what stock you're following on our website, as long as we cover it and have a call on it, if we change that call, you will be notified immediately. So you don't have to be in front of your computer to get the latest information. So do keep an eye out on that. If you don't have the app yet, please download it. Now, this slide here that we're going to be looking at is, I've taken this data from Morningstar. So there's 9,317 managed funds on Morningstar. There's 151 exchange traded funds, and there's 93 listed investment companies. Now, imagine someone, this could even be yourself, you've just finished work, you've retired, you've got a self-managed super fund that you've set up, and you're looking to try to manage it yourself. You're looking to pick one or two managed funds to suit your needs. Maybe even have a dabble in exchange traded funds and listed investment companies yourself, whilst taking a relatively hands-off approach. You're going to pick those funds and those ETFs, and then you're going to put them aside, check on them every, say, quarter, but still live your life. When you're confronted with this 9,317 managed funds, it's a pretty daunting figure, considering there's only 2,000 odd stocks in the market. So what we're going to go through today are the key components of what I look for to break down this big number. So today, in a nutshell, in this next slide here, we've got the people, the process, and the product. So I really do want to know who's behind it. I then want to see how they do what they do, how they make money for you, and then I want to know how it's delivered. And that could, in some instances, be the most important factor in deciding, making an investment decision for yourself. So in my own mind, I call them the 3 Ps: the people, the process, and the product. So moving on here to the people. My first dot point on this slide is, can you name the chief investment officer or portfolio manager for the investment product you're looking at? Say if it's a managed fund, do you know who the chief investment officer is? And why I ask this is because what I'm trying to identify is key man risk. I want to know that if someone was to step out of the office and accidentally get hit by a bus or a tram, and that person happened to be the chief investment officer, what will happen to my investment? Will it still be in safe hands? And a really good example of this is actually our own business here. I've run approximately 8 or 9 of these sessions covering this exact same topic in Melbourne and in Sydney, and I'll soon be doing them in Brisbane next week as well. And only one person out of every single group that I've sat in with has been able to name the Intelligent Investor's head of research. And that to me is a good thing. It shows we've got a relatively flat structure, which means we're strong across the board with our depth of analysts in our analyst team. So what I'm then looking for is the team's overall experience and looking for a track record. It's really easy to do. Every website these days has got an About Us section. You should be able to jump on there and see the team. And then if you don't have a LinkedIn account, set one up, jump onto LinkedIn, search those people, see where they've been before. It's really easy. And then when you can see where they've been before, you can then go back and look at the funds that they've been with. You can then look at that time period that they were with them for and compare it to that fund's performance during that period and see if they've contributed positively or negatively to that. Now, what I think this is really important for is also assessing brand new funds or brand new products. The reason for that is you're looking at these things and they do not have a track record. They don't have 5 and 10 year numbers for you to easily look at and get comfortable around. So I want to see, have they run this strategy before? For example, at Eureka Report, we had a number of articles on a stock, PM Capital Asian Opportunities Fund. It was relatively newly listed. It's a listed investment company. When we started looking at it, it didn't have a long track record, but the manager behind it had been running an unlisted strategy of in Asia for that company for about approximately 5 or so years. And I could see a consistent, solid track record there, and he was running the exact same strategy on the listed investment company. So even though it was relatively new, I still had a good guide, and I was able to build more confidence in that recommendation. Now, finally, I've got on this slide here, transparency. How open is the manager? What I'm looking for here is what do they show me of their portfolio? I want to see someone who shows me a lot of it. I want to see at least 10, the top 10 holdings in a listed investment company or a managed fund. And this kind of gives me a bit of a feel, and I can marry up what they say they do with what they actually do. Do their words match their holdings? And what I'm looking for here, because every single manager will send out a monthly report, I'm looking to break down the months and see their negative months and see what they've had to say during those reports. I want to see how transparent they are. Do they show you their winners? Do they show you their losers? Because every single person, trust me, will have their losers. We do, but we also have our winners. So the next slide here shows you our investment team, and as I was saying, it's a relatively flat structure across the board. Only one person could name our chief investment officer or head of research, and I wonder if you guys can as well. That person is actually James Carlisle. He's second in charge here is Gaurav Sodhi, and then we go down the list. And so we've got a relatively flat structure across the team. Anyone can bring up an idea to the investment table. Now, the following slide, it's called skin in the game. Another thing I want to see from my managers is that they are invested in their own products. I want them to feel pain when I, the investor, feels pain. Now, I know here at InvestSMART, a large number of the staff are shareholders in the business. INV is our stock code. But also a number of us, including myself, have portfolios managed by our investment team. So ask, if you're sitting down looking at a fund manager, ask them to show you, are you invested in your own products? See a holding statement, even if they should be happy to show you. If you're looking at a listed investment company, look up the top 20 shareholders and just do a little run through and see if the names that are managing the portfolio are within that top 20 shareholding list. It's really important that they are feeling the pain when you feel it, and of course they get the wins when you get them. Now, my following slide is called When Repeating Yourself is a Good Thing. This goes back to looking at when a manager doesn't have the best of months or the best of quarters or the best of 6 months, for example. I want to see consistency in their message. Okay, consistency in what they're telling us. And also, I want to see transparency during those bad months. Now, how you can see that, a lot of managers will publish their monthly figures, their monthly performance numbers. And you'll be able to see when they diverge from the market. Highlight those months, go back and look up those specific reports that coincide with those months. Look at their messaging and look to see if they waver from it or not. Now, consistency is really important here. If you are looking at a manager, do go back a good number of months, even years, and just see what they choose to show you. I, for example, know of a particular company that I've followed for a long time where they always had their performance on a nice chart measured against their benchmark. I was looking at that and I knew their performance was dropping away, and I knew it was going to slip significantly below that benchmark, and it was going to look relatively unfavourable. The following month, when a new update and a new announcement came out, that benchmark line had disappeared. So unless you were following that particular company, and unless you were looking back at the historical announcements and updates, you wouldn't know that that benchmark was there. That's a bit of a red flag to me. Okay, so that's what I'm looking for here. Now, moving on to the process. Firstly, what's really important to me is, do you understand how the manager invests? To me, there is no use in making returns unless you know how you got them. The reason for that is because they are not repeatable. Okay, and that goes for yourself as an investor at home, but also for the manager, of course. They need a strong and solid, robust process. Once again, I've got another thing. I'm repeating myself here. Do you see the manager repeating the same key messages and phrases? And then how can you tell if a process is robust and repeatable? Now, there's a saying in financial markets, past performance is no indicator of future performance. And that's 100% true. But what I do like to look for to see if a process is repeatable and robust is looking back and seeing a good solid track record through all, and the longer I go back for, from say 5 years or even 10 years, the longer the better, because they're going through different investment cycles. They're coming through the GFC, for example. They're coming through Brexit. They're coming through, in the future, Trump. But what I'm also interested in seeing that for is because as we go through different economic cycles, businesses change. Fund managers are businesses, and they employ people, and analysts are people too. Believe it or not, they actually are. And so they come and go. They're not always going to be at that one company. But if that manager has a robust process that is repeatable, it shouldn't matter if they have the odd occasional staff member go. There shouldn't be that key man risk, and they should negate that with a strong process. And so the managers out there that have performed month in, month out, quarter in, quarter out, and year over year, I can tell you they have got a strong and repeatable process. Now, talking about our process here with the Intelligent Investor team specifically, the next slide, I've got a quote here, the man with a hammer syndrome. To the man with a hammer, every problem looks like a nail. Now, what we try to do is we do not put one single formula across the entire market or one single filter across the entire market to pick our stocks. We just don't do that. Our process here does not rely on a filter or rely on pushing data through a specific formula to give us specific outcomes to then go and look at just those stocks. So the following slide, sector by sector, company by company, that is how we do it. We prefer, instead of looking at some key ratios that we've jammed through a specific filter, we would prefer to spend more of our time just looking at a company, talking to management, understanding the business, understanding the industry that it operates in, and rather than poring over numbers to get to a price target of within 1 or 2 cents. We're not interested in that. If we understand the business, if we understand the industry, we should be able to get a better insight into understanding what the business is going to look like in the next 5 to 10 years. That to us is more important. Saying that, once we have a good idea of that and we like the look of things, we will then put the numbers through typically some pretty standard valuation metrics. One of those being, of course, a discounted cash flow methodology. That is what 9 times out of 10 we will use. Now, saying that, on this next slide here, there are some key ratios per industry that we do look at. And as I said, it's not a one-size-fits-all type of equation here. With manufacturers, we look at different things. With retailers, we look at different things. If we move across to the next slide here, we've got banks and infrastructure. We look at different things, of course, for banks. We look at different things for infrastructure. But of course, there are common themes across all of them. Debt is really important to us. We don't typically like to look at too many things with a net debt to equity ratio higher than 50%. However, that doesn't stop us from looking at it. It just is a red flag which we want to investigate further. Now, also as a part of our process here, this is going back to something that I said that we've got a flat structure and anyone in our investment team can bring an idea to the table. For a company to get into the Intelligent Investor Growth Portfolio or the Intelligent Investor Income Portfolio, it needs to go through what we call a Dragon's Den. That's a process where the analyst who is covering a specific stock, if they're really keen on it and they have done a lot of work on it, they'll put together a presentation and then the entire analyst team will get together and they'll sit through that presentation, and the other analysts, their job is to try and pick apart that analyst's specific investment case. Which going across to the next slide here, I've got checklists. We all have our checklists that we go through, and this is to help us understand a business better and to actually help us build that investment case. So some people we use checklists all the time. This specific one that I've got here, just a few key points, is a very simple one, but it is one that's going to help you at home make better investment decisions if you are picking your own stocks. Once again, I will send this presentation around to everyone, so if you did want to jot down any of these, if we are going a bit too quick, you'll be able to go back to this particular section. On the following page here with the checklist continued, the last point I've got there is what is the worst case scenario? Can we build the perfect storm? And that goes back to that Dragon's Den process. Our analyst team try to pick each other's investment cases apart, and only the strongest investment cases do make it into our portfolio. Now, with our investment process here, the portfolio construction side of things, the Intelligent Investor Growth Portfolio and the Intelligent Investor Equity Income Portfolio, they are 100% fully invested portfolios. Generally speaking, you might have 3% cash in that portfolio, but not a great deal more. Now, the reason for that is because we are not trying to time or pick macroeconomic events. and we're not trying to time the market. We're trying to buy the best opportunities out there at any one point of time. And so for a new stock to enter our portfolio, it needs to be stronger and have more potential upside, so a deeper discount to value, than our weakest stock in the portfolio. And so we will switch out, we'll sell that weaker one and move the new one into the portfolio. That is how we will operate our model portfolios and how we construct them. So speaking of that, the process of portfolio construction, on this slide here, it does show you the top 10 holdings in both the Intelligent Investor Equity Income portfolio and the Intelligent Investor Growth portfolio. You will notice, if you look at the entire list, as you can do on our website, you will see quite a crossover in shares on the growth portfolio and on the income portfolio. The reason for that is everything here starts with value. We are looking for value. And if it's a value stock and it is paying us a nice dividend and we see some upside in that in growth, then we are going to hold that position in both portfolios. So currently there's only about 6 stocks that are different across both portfolios. Now, for example, in the growth portfolio, we hold a position in a company called Nanosonics. Nanosonics doesn't pay us a dividend, so that's why it doesn't make it into the income portfolio. In the income portfolio, we might have a couple of banks in there, which we wouldn't have in the growth portfolio. The reason for that is, of course, we do see some upside in them. We're getting a good dividend from them, but not enough upside to make it into the growth portfolio. They're not undervalued enough. So moving on to the next section, which is the product. Now, I think this is just as important as the last two, potentially even more, and we're going to spend a bit more time here unpacking this. Now, I will remind you, if you do have any questions, please submit them as we're going along. Typically in our in-office meetings, people just jump in and interrupt me as we're going, which is great, but I will answer all your questions at the end and we'll come back to them, but do answer them as we're coming along. So the product. First cab off the rank here, we've got exchange traded funds. So if I'm looking at an exchange traded fund myself, they are pure, generally speaking, pure index trackers. What I'm looking for is the biggest and the cheapest. That's essentially it. If you are tracking an index, like the ASX 200, what the ETF should do is underperform that index by its fees. That is what a perfect ETF should always do, and hence why we look for the cheapest and the biggest. The reason why we look for the biggest is the bigger it is, the less risk of tracking error we have. So, and then my last point on this particular slide as well is watch for managed funds disguised as ETFs. Now that's a little bit controversial, but what I'm saying here is there are a lot of exchange traded funds coming onto the market these days. Some of them are tracking a pure index, and some of them, of course, are tracking an index of their own making, designed of all sorts of different rules. There is nothing wrong with that, but just be aware of what it's actually trying to do, and just be aware of the additional costs that come with that. Now, I have seen some of these with a management fee of up to 0.5%. But just like normal businesses, an ETF does need to have an annual report. In that annual report, you're able to go in there and see what expenses there are as well. So you've got management fees and you've got expenses. When you combine all the expenses, including the fees, and you divide it by the total assets within the portfolio, you get the management expense ratio, or the MER. That is what you should be looking for when you're looking at an ETF, an LIC, or even a managed fund as well. Now, speaking of listed investment companies, we'll come across to the next slide here. Now, what investors need to know about these, they are locked in pools of capital. The manager goes out there, they raise the money once, and it is locked in. Investors can come and go by finding another investor to buy the shares from them in the market. But the underlying pool of capital is 100% locked in to the manager. Now, that can be a very good thing. What that allows managers to do is to set a strategy for the long term. So they can go out there and buy companies with a view of the next 5 or 7 or 10 years and not have to worry about the comings and goings and the ebbs and flows of money into and out of their portfolio. Okay, so they can position the portfolio really well. The negative side of that is, once they've raised the money, there's quite often not a lot of encouragement for them to go out there and actively advertise and actively market that fund. So what that can tend to do is lead to a slipping between the underlying value of the portfolio and the share price. So just keep that in mind. If you're seeing a portfolio that is performing okay, but the share price is consistently trailing behind the underlying value measured by the net tangible assets, which you'll be able to see every month, sometimes week, and in a couple of occasions daily, then that's perhaps telling me that the underlying manager is maybe not doing as much as they possibly can to get out there and promote that fund. For a lot of them, the incentive just isn't there. So just keep that in mind. Now, the other thing that I do like about listed investment companies is the word company. Unlike an exchange-traded fund and a managed fund, which are unit trusts, a company can smooth out the dividends and distributions to its shareholders. A unit trust needs to pay out all income as a distribution as it comes in that year and realise gains as well. For a listed investment company, it can retain its earnings and retain some profit to be able to smooth out future dividends going forward. So if you were to look back through, say, periods like the GFC at listed investment companies like AFIC, Argo, Milton, BKI, you'll be able to see that they've slowly over time just increased their dividends, not by much, but just over time gradually they've built them up. And that's because they're able to retain those profits to smooth out that distribution for you. So that's another really good thing. Now, I have put down here they're not flexible when it comes to income and contributions. The reason why I say that is because if you do want income, and that income's incredibly important to a lot of our members, if you do want income outside of those distribution periods, you're going to have to sell shares to take it. And I know a lot of people actually don't like to do that. The last point I have here is check for total fees and expenses. Just like in an ETF, you can jump into the annual report of a listed investment company, go to the total expenses section, and then divide the total expenses by the total assets. And that'll give you an idea for the true cost that is coming out of your pocket. So a lot of them will advertise their management fee and their performance fee. What they won't tell you is the actual underlying cost of running that strategy, which you pay for as an investor. Okay, so we're talking about brokerage and marketing as well. We're talking about all sorts of things, directors' fees, etc. So just keep that in mind, because at the end of the day, it comes out of your pocket. Now, the next slide shows the negative aspect of listed investment companies. This shows us listed investment companies here by market cap. You've got AFIC at the top, which about $6.5 billion. You then have Argo at roughly $5 billion. You've then got Milton, and then it's Daylight. Very few, and these are the top 20 on the market currently. Very few are above $1 billion. And what that means is, when I show you this following slide here, when I say LICs by volume, they are highly illiquid. Apart from Wilson Asset Management, WAM Capital, which is the most liquid LIC out there, interestingly enough, probably the most well publicised and marketed LIC out there on the market as well. It is that LIC and then Daylight for the rest of them for when it comes to liquidity. Okay, so that can hurt you if you do need to sell down shares to take income, or if you need to sell down shares to move elsewhere, or you need to buy into them. If every single one of you watching this afternoon went out to try and buy one of these LICs, you'd all struggle to get through the door. Now, moving on to managed funds. Once again, I've got up the top here, keep a close eye on fees. I'm not someone who, strangely enough as it seems, likes to harp on about fees, but you do need to keep them into consideration. if the fund manager is performing for you year in, year out, or the listed investment company is performing for you, then the manager is worth their fees. But if they're not, well, you'll have to have a second glance then. Now, it's important to note as well when it comes to a managed fund, you own units, not shares in a company, okay? And once again, to take additional income, like shares, you'll need to sell down those units outside of the distribution period. Importantly, a managed fund within the structure, it is an open-ended fund. That means money can come in and money can go out at any particular point in time of that fund's life. Now, typically from my experience, what you see is a time when the manager least wants the money is when they get the most. So when the market's high and everyone's really happy to talk about their superannuation funds at a barbecue and how well they've done, everyone goes and piles into fund managers. No one then wants the actual money because they cannot spend it. Okay, they cannot go out there and buy undervalued stocks. And then on the inverse of that, when the market crashes or there's a correction and no one wants to talk about the stock market and the manager has a plethora of opportunities of undervalued stocks that they want to buy, the funds are actually exiting the managed fund. So that's an issue that investors need to keep in mind. You could be very happy to sit there as a unit holder in this managed fund and ride out the ups and downs, but your performance will be negatively impacted by the comings and goings of others around you, okay? Even though you are sensible enough to ride out these waves. So just be careful of that. Managers can be forced buyers and they can be forced sellers to meet redemptions in a managed fund structure. Now, the next slide here shows us what we do. We have specifically chosen a structure that's called a separately managed account. That is for our intelligent investor portfolios, and it's also for our InvestSMART diversified portfolios. The reason why we've chosen these are we think it will suit the needs of our members the most. They are not pooled investments. You actually have full beneficial ownership of your underlying shares. Okay, so you can log into your account, you can see every single share you own, which going back to that issue about transparency, that is certainly not there with us. And you can click on every single stock and see our research on it. So you know why we're buying something when we're buying it. You know why we're selling something when we are selling it. From our largest position to our smallest position, you will know. And the other reason why we've chosen separately managed accounts is because, once again, unlike a managed fund, when you're all in that one pool, you are in your own little pools. So we have, say, well over 300 clients currently in our separately managed accounts. That means we've got over 300 different individual silos for those people. So if client A wants to leave, they can sell their shares or they can transfer them out to a broker and leave. They do not impact you sitting there next door to them, okay? And also there are lots better for tax efficiency as well. And one other thing, this is very, very important to us here. We can manage someone's need for income really well with a separately managed account. So because you actually own the underlying shares, you have beneficial ownership of those shares, what you're able to do is actually have the dividends as they are paid transferred straight into an account that you link of your choosing, so they can go straight into your spending account. Now, you can have them reinvested back into the portfolio and then they'll be reinvested across the portfolio as our analyst team reweight the portfolios. Or you can have your dividends come out to you and then you can have, say, a set drawdown as well across a monthly period, say $1,000 a month, $2,000 a month, whatever you like. Or you can also take ad hoc payments. Say you need $5,000 here, you need $2,000 there, that's no problems. We can manage all these within this structure and it's really quite simple. So that is why we've specifically chosen this separately managed account structure. And they're also quite cost efficient as well to run. Our portfolios start at 0.97% per annum. We do not charge performance fees on our Intelligent Investor growth and income portfolios, or on our InvestSMART diversified portfolios as well. Now, the big benefit of there, of course, is all the growth stays in your pocket, which is what we want to do. Now, finally, on this second last slide, it used to be the last slide, but it's second last now. The core question you need to ask yourself is, why are you doing this? What are you wanting to achieve? Actually write it down. If it's to get a very specific income target, write that down. If it's to grow the portfolio in time to afford, say, your first house or something like that, write that down. Know why you're trying to do this. Because some managed products will suit other people. Say if you're like me, you might be towards the start of growing your nest egg, so to speak. I can use a lot of different products. I can park my money in something that is quite inflexible for me to get out of it, and let that money just build up over time. But if you're, say, in pension mode and you're relying on that portfolio for income, then you might need the steady stream of those dividends flowing through from a product like a separately managed account. So just keep that in mind. Now, finally, as you are walking up and down, say, Collins Street or Pitt Street or wherever they are in Sydney and Brisbane and Adelaide and wherever, and seeing managers as you're ticking off ones to potentially invest in, when you walk out from somewhere and decide not to invest in it, actually write down your excuses, because that'll shorten the list and it'll actually make you sharper when you go in somewhere. It'll actually pinpoint what you are looking for. Your excuses will lead you to finding someone and the right fit for you. So now what I'm going to do, I'm going to go to the questions. Hopefully there's been quite a few coming through. I don't know, because I've been looking at the PowerPoint. But I will leave this last slide up here. Coming up next Thursday, Tony Kay, the editor of the Eureka Report, is going to be joined by two financial advisors, Max Newnham and Bruce Bremmel, and they're going to be talking about the new pension rules. So that's going to be a live advisor Q&A next Thursday at midday. So do join us for that presentation. Send in your questions, especially if you've got a self-managed super fund. I think it's going to be certainly well worth your while joining in there. Now, I'm going to go to the questions here now. David says, please advise if the slides are available by email after this session. Yes, I will. If you, David, or anyone else out there wants the actual slides from this presentation, please email me. I'll be able to get them all to you. My email address is m.sneddon, that's SNEDDON, @investsmart.com.au. Alternatively, just email our generic inbox and we'll be able to get those to you. Let me see here. Colin, how do you assess ETFs with short histories? Well, if they're just tracking an index, Colin, I just essentially look for the size and look for the fees that are coming out of them. That is it. If they are tracking an index that has been around for a long time, like the MSCI All World Index or the S&P 500 or the ASX 200, for example, I have no qualms about that. But then when it comes to the actual smart beta exchange traded funds, right now I still want to watch them from the sidelines. I just want to watch how they go, how they do what they say they're going to do as well, and especially, say, for example, if it's meant to be a lower volatility portfolio or a higher income portfolio, I want to actually see if it does that. So time is the best thing to do. Give the exchange traded fund plenty of time and just watch it from the sidelines. Now, Mark says IOOF is regarded as a safe and stable. IOOF is regarded as safe and stable as an investment. That'd be one for our investment team. If you do jump onto InvestSMART or Intelligent Investor, you'll be able to see all of our research there. I specifically do not cover IOOF, Mark, so unfortunately you will jump on to Intelligent Investor or InvestSMART and you'll be able to find all of our research and read up on it. Joy says, if I invested in a fund with a goal of income, then firstly, how is the balance of my investment reported, i.e. dollars or units or other? Secondly, how do funds provide an income stream to my SMSF? So Joy, I presume if you're investing, say, specifically in our income intelligent investor portfolio, what you would be invested in there is around 20 to 30 ASX listed companies that our analyst team has picked specifically for that portfolio. You can choose to take that income however you like. As I mentioned, you can have the dividends paid by those stocks as and when they pay them transferred directly to your bank account of your choosing. Or you can have them go back into the portfolio and you can choose to have a drawdown of whatever amount you like over a period of time. Or you can take ad hoc payments. It's 100% up to you. It's very flexible. How do you provide an income stream to my SMSF? That's exactly it. How is it reported? It's reported in dollars, but just like, say, you've got a broking account with CommSec or a broking account with E-Trade, just like you manage your own portfolio, when you log on, if you are invested with us, you will see your portfolio there. You'll see the amount of stock you hold in each one. You will see the dollar value invested in each one initially. You'll see the current value of that. You'll see the dividends received, and you'll see the total gains and or losses from that position. So you get full transparency there. I hope I've answered those questions for you, Joy. David has a comment here. Separately managed fund reporting. Do you regularly provide balance and performance data to superannuation administrators? If you are a separately managed account client like myself, I'm invested in the Intelligent Investor Growth portfolio and our international equities portfolio. You have 24-hour access to your portfolio to view it, so you can view it whenever you like. So you can see the performance, you can see the transactions, and you can see the balance of every single position and the portfolio as a whole. Okay, you can see that as you log in just to your regular InvestSMART account, you'll be able to see that. For the sake of superannuation administrators and accountants, at the end of the tax year, we will put together a comprehensive tax statement for you, which you'll be able to just pick up and put on your accountant's desk. We can as well run a whole swag of reports from our system. The back end we use is Premium, and from that we're able to get a lot of reports that accountants may or may not need. Just email us at invest@investsmart.com.au and we're able to get those reports to you, or pick up the phone and give us a call. All of our clients are able to do that, and we're happy to do that for you. Now, it looks like we've got one more question just coming through here from Bronte. With international managed funds, what is the best benchmark? It depends on specifically what that fund is trying to do. Typically, of course, they will have their own benchmark. But what I like to do is actually benchmark my total portfolio against what I want to achieve. If I'm trying to get a return of 7% or a return of 10%, that's what I'm benchmarking myself off, my total portfolio. With an international managed fund, a lot of them will benchmark themselves off the MSCI All World Index or the MSCI All World Index. So that is typically the one a lot of them go for. But if it's a US-based one, if they're investing primarily in, say, mid-caps, you can go the S&P mid-cap index. If it's the primarily large caps, you should, of course, go off the S&P 500. It just depends on the actual fund itself. See where they're investing and find the relevant benchmark. Some do, of course, they'll have their own benchmarks, of course. Some are more relevant than others. But for now, thank you for joining us, and I hope you've enjoyed this and got something out of it. We will be back with more investor sessions, and they won't always be about managed products. They'll be about all sorts of things like portfolio construction, etc. So do stay tuned, and hopefully we'll be able to get to a capital city near you and you'll be able to come and visit us. And do remember, next week, Tony Kay with our advisors talking about the new changes to super. So for now, good afternoon.